A new plan has just been proposed that would eliminate the Federal Reserve's ability to pay interest to banks on reserves held at the Fed. And according to the pitch deck, this would save the US government $1.1 trillion over 10 years. Now, if that sounds completely crazy, we have to get into the backstory a little bit here, and hang with me because it will get a little technical, but I promise I'll break it down simply at the end. This is a chart of reserves held by financial institutions at the Federal Reserve. In other words, the Fed is kind of like a bank for other banks. So when you're looking at a chart of reserves, it's kind of like you're just looking at the sum total of all of the accounts that banks have at the Fed. Right now, there's about $3.3 trillion in reserves held at the Fed. Now, when you hear about the Federal Reserve making a decision to lower or raise interest rates, they are not making decisions about raising or lowering mortgage rates, credit card rates, auto loan rates, even treasury rates. The only interest rate they are talking about is called the Fed funds rate. And that is the interest rate that they pay to banks on those reserves held at the Fed. Okay, so quick note of clarification for anybody who cares about nuance and complete accuracy over just generalized understanding. Technically, the federal funds rate is not the interest rate that the Fed pays to banks on their reserves held at the Fed. Technically, that is called the IORB, or the interest on overnight reserve balances. Now, the federal funds rate is the range that the Fed wants banks to pay each other on the cash that they lend to each other overnight. The Fed uses the IORB to pay interest on reserves at the Fed in order to make sure that the federal funds effective rate stays in between the federal funds range that it wants it to stay in. How does this change anything we're talking about today? It doesn't change it at all. But I know there are some of you who technically know there's a difference, and I wanted to make the clarification for anybody who cares. But because the Fed uses the IORB in order to maintain the effective rate on the FFR between its preferred range, the rates are going to be usually pretty close to identical. Okay, now back to our scheduled programming. This is a chart of what the federal funds interest rate is. And right now it's at 4.33%. Technically, the Fed funds rate is a range. This chart that you're looking at here is the current effective rate. So at this point, you're probably wondering, well, why in the world would stopping the Fed from paying interest on these reserves have anything to do with saving the US government money? Well, take a look at this chart again, because you've probably noticed something interesting, which is that prior to 2008, banks really didn't hold any reserves at the Fed at all. The amount of reserves held at the Fed was pretty consistent in between $20 to $60 billion. But then suddenly it exploded to $1 trillion, and then $2 trillion by 2013, and then $3 trillion by 2020, and currently sitting at $3.3 trillion. And the reason why banks really didn't hold any reserves at the Fed until that point is because payments of interest on reserves only started in 2008 during the financial crisis. Total interest payments started out around $1 billion. And as of today, those interest payments have climbed to approximately $186 billion. Now, the reason why the Federal Reserve started to do this is basically to make sure that interest rates didn't go negative. This is a chart of the Federal Reserve's balance sheet, and you can see they started purchasing a ton of US Treasuries and mortgage-backed securities around the same time in 2008. They've continued to do that ever since, ballooning their balance sheet to a top of almost $9 trillion, and it's sitting now at about $6.6 trillion. When the Federal Reserve buys assets from the financial markets, they're taking newly created dollars and replacing those assets with those newly created dollars, which means that those financial institutions that sold those assets to the Fed now no longer have an asset, but they do have cash that they have to go out there and do something with. During times of increased government borrowing and spending, this feedback loop can push interest rates very close to negative territory. You can see in the fallout of the financial crisis, interest rates approached 0%. And you can see again after 2020 and in early 2021, interest rates approached 0% yet again. And this is because financial institutions just have all this fresh cash They've got to do something with it. So they're going to go out there and they're going to buy something that produces interest for them. But all that buying pressure drives the price up to the point where yields get so low, they're verging on going negative. In order to prevent that from happening, the Federal Reserve says, hey, don't take your cash and go out into the marketplace and buy things like T-bills. Instead, park that cash with us at the Fed, and we will pay you an interest rate instead. That way you're not going out there as a bank, buying up assets and driving up those prices and potentially making interest rates go negative, breaking global financial markets. And so the interest rate that the Federal Reserve pays on reserves has been a tool to keep a floor underneath interest rates. Because if I'm a financial institution and I've got $1 billion to deploy, do I want to buy some corporate debt that has a high chance of default? Or do I want to take on less risk and buy US Treasuries, which have almost no risk of default, even though there is still some? Or I can take that cash and I can park it at the Federal Reserve in my bank account at the Fed, and I can get the exact same interest rate, actually risk-free? Of course I'm going to do that all day long, which is why there's $3.3 trillion in reserves currently sitting at the Fed, because it's basically a risk-free savings account for banks, and they can get paid that interest rate with zero risk of default. And that keeps a floor underneath interest rates, because I'm not going to lend money to the US government with a tiny risk of default unless I can get a better interest rate than what I could get if I give that money to the Fed. And so this recent proposal to eliminate the Fed's ability to pay interest on reserves would likely take reserves held at the Fed very close to where it was prior to the financial crisis, basically zero, which means you've got $3.5 trillion or close to it that will suddenly need a place to go in order to get interest. And where is all that money gonna go? Well, it's gonna go to the next place that is almost risk-free, which is T-bills. In other words, short-term US government treasury bonds. Now, supply and demand, more money coming in to buy up T-bills means those prices go up, yields go down. It makes borrowing for the US government temporarily easier. It also means that when interest rates go down and the government borrows that money at a lower interest rate because there's all that fresh cash that wants to be lent to it, it means that the US government's interest payments temporarily go down, which means that the deficit temporarily goes down. But that's not all. Right now, the Federal Reserve is printing money to pay that interest to banks. But if you remember, the Federal Reserve has a balance sheet and holds $6.6 trillion worth of assets. Those are assets like treasuries and mortgage-backed securities that actually pay interest to the Fed. So the Fed has a portfolio of assets that pay it interest, and that interest on $6.6 trillion worth of assets is not enough to cover all the Fed's expenses right now, which means they're printing money to pay interest on all those reserves to the banks. But if the Federal Reserve can no longer pay interest on reserves, and subsequently reserves go down close to zero, then the Federal Reserve's bills essentially drop by a huge amount, which means that the Federal Reserve will likely be profitable again. In other words, all of the interest that is getting paid back to the Fed from the assets that are on the Fed's balance sheet will be more than all the Fed's expenses again. And what does the Federal Reserve do with its profits that are in excess of its expenses? It pays those profits back to the US government, back to the Treasury. Okay, now to break it down simply. Right now, you have a bank who has all this excess cash and it doesn't want to take any risk with it. So it parks that in its savings account with the Fed. The Fed currently makes income from taxpayers as we pay the US government from our paychecks in order to service the debt. A lot of that is held by the Federal Reserve, so those interest payments are getting paid to the Fed, and that's not enough for the Federal Reserve to make all of its payments to those banks that are holding their cash at the Fed. So the Fed prints up extra money in order to pay those banks the interest on those reserves. So this proposal says the Fed should no longer be able to pay interest on those reserves. That will mean that $3.3 trillion will leave the Fed and instead turn around to the US government and be lent to the US government directly. This will drive down interest rates for the government temporarily as there will be more demand for US government debt. This will make interest payments temporarily cheaper. This will make the deficit temporarily smaller and make the debt accumulation temporarily a little slower. But it also means that the Federal Reserve will have a huge expense wiped off from what it has to pay, which means that all the income it produces from the interest that it gets paid on US government debt that, again, taxpayers are paying for, a lot of that will be able to get swept right back to the US Treasury in the form of excess profits sent back to the government. And that's why they estimate that this will save approximately $1.1 trillion over the next 10 years. So what are the downsides of this? Well, number one, it means that banks will have to take on a little bit extra risk by loaning to the government by buying T-bills instead of parking it completely risk-free at the Fed. Boo-hoo, right? Well, there's a second risk, a second downside. Second downside is that this is not going to stop government spending. This is not going to stop government borrowing. This is not going to stop the debt accumulation. This is not going to stop crazy spending. This is just going to make it temporarily less painful, which means the government's probably just going to do more of it. And every dollar the government spends comes out of your pocket, whether it comes out of your paycheck in taxes or whether it comes out of your paycheck in the form of goods being more expensive to buy. You don't fix a drug addict's addiction to drugs by giving them more and cheaper drugs. You don't fix a debt addicts' addiction to debt and spending by giving them more access to cheaper debt. And you don't fix the government spending problem by giving them more access to spending power. So is this a pretty big band-aid if this actually happens? Yes, but it is a band-aid nonetheless. We're in a new phase of the debt cycle. The falling rates and the disinflation from 1980 to 2020 are done. We are seeing more volatility and flash crashes in the market today than we have in the last 100 years. This is all a result of markets adjusting to the new normal. You need to take advantage of this. Also protect yourself against inflation and be exposed to the melt-ups in asset prices that happen along the way. If you don't know how to do this, I've created the perfect guide for you. It's called the Hedged Hypergrowth Portfolio Blueprint. I've got it linked for you down below. It's the cheapest it'll ever be. I am going to double the price very soon, so get it before that happens. As always, thank you so much for watching. Have a great day.